Really, what this is saying, or what I'm trying to say here is, when we do our technical work in the industry, we make our beautiful maps, we do our subsurface studies, all of those things. The end goal is profitability. It's a business at the end of the day. That's where we come in as financial modelers. You're trying to ascertain how viable the project is. Does it make sense to go into it? Will I make money? Will I not make money? So every business has a desired goal. And at the end of the day, that desired goal is, like I said, profitability. We intend to make money. Money is the bottom line at the end of the day. So the purpose of this presentation is to introduce the basics of financial modeling in the oil and gas industry with a focus on the trend. When I say the trend in this case, now we're talking about um, technological improvements. We're talking about the direction of the global economy. At a point, we had the global shale oil and gas. That was a trend at that point. Fracking became a technology that people were jumping onto. At a point in time, there were no horizontal well drills. All of these things affect the dynamics of the oil and gas economy. So understanding financial modeling. Financial modeling is a representation of a company's performance with the use of quantitative data analyzed and vetted for profitability and value creation. From my introduction up until this point, you can see I'm going, everything I'm talking about is monetary wise. We're converting value that has been found in the subsurface into value that will be found in our accounts. So the purpose of oil and gas is decision making for investments, project viability, risk assessment, portfolio management. When we say decision making for investments, I would speak like a layman in some sense, so it's easy for everybody to follow and grasp. I didn't get a general understanding of the background of people here, but I'm assuming we have a lot of technical students and professionals here also. So for decision making for investments, generally a company will have different assets. Sorry.
No, go ahead, sir. Continue.
Okay. So decision making for investments, generally a company will have different investment portfolios. And as a financial model and analyst, what you're looking to do now is to put this investment options side by side, check how profitable they are, and help management come to a decision on what is best to invest in and what is best to leave in the um, bucket list going forward. So key components of oil and gas financial models would have your assumptions. I like to split modeling into simple bits, but we'll go the assumptions. We have the price forecast, the production rates, the operational costs, the capital costs, and the applicable fiscal terms. Now, price forecast. In the oil and gas industry, generally, there's a cycle. There are times when oil prices will rise and get to an all-time high, and maybe global situations happen. For example, Russia-Ukraine war. In some other cases, you have what's it called that I just spoke about now, the shale oil and gas thing that happened in America at that time. It affected supply. There was excess supply of oil and of hydrocarbon oil in the market, and thus crashed the price. In this case, Russia-Ukraine's war has affected the supply globally, and it's not able to meet the demand. Thus, the increment in oil price gets into the 80s. It's currently in the 70s now, though. Next is production rates. Your production rates will also be a determining factor on how it is your oil and gas financial model will turn out. You have dwindling production rates, and then cost of producing the assets is too high. you would expect to not make money. General trend. We have operational costs. Depending on the kind of asset and the scale of the asset, you might have to you'd have to consider what you need to do to get the asset operational and keep the asset running. If your asset is located in a secluded location where you don't have close by facilities, and take for example your estimated ultimate recovery EUR is about 7 million barrels. You don't have anywhere to flow to. You need to put an EPF in place. That's a processing facility. These things will cost money in terms of capital expenditure, and at the same time, to operate the asset and evacuate your produced crude from location would also cost money. Now we have our revenue streams. Okay, sorry, I jumped. There's still applicable fiscal terms. Applicable fiscal terms. Let me just give a brief background history. When oil and gas was found in Nigeria, what was done that time by DPR was joint ventures. So we had the big investors that had the money to come, the Chevrons and the Totals and the likes then, ELF then. They came in, and then we decided with NNPC, let's do it this way. It's going to be a joint venture. But because I'm the landowner and I own these assets, what I'm going to do now is that I'll be the operator of the assets and I'll own major shares, 55%, 60%, whatever the case may be. Then you, as the joint venture partner, you will own 45% if I own 55%. But that will now mean that the liability of producing that asset, the cost liability will be shared 55-45 also. Initially, it was a good idea when it started, but then it got to a point with the number of assets that are being developed and OMOs that are being put into production, it was not as exactly feasible for them to carry on that way. It means for every single asset that they have, to develop the asset to get it to production, to further develop the asset to optimize the assets, 55% of the funding will be required to come from NNPC then. Then the idea of a production sharing contract came up. It said, okay, since these JV licenses are expiring, let's jump away from this. What we'll now do is that when you do producing companies, the international oil companies and the likes want to produce assets, I will not bring 1 naira, but I am the landowner. You bring your money, invest your money. I'll give you incentives. If you find oil, then you pay me some certain percentage. That kind of arrangement. So they're able to push out the part of where they have to bring in money for those large sum investments that way. Going forward, petroleum sharing contract, production sharing contracts were going on. Then there were smaller assets that these larger companies will see and they will decide this asset is not what is going to make money for me. It's too small. Let me just leave it in the pockets there. Now, DPR came back again and said, these smaller assets people are dumping one side. If you're not going to produce them, farm them out to other people or bring them back to us. Let us give them out to people that can produce and make money from there. Also increase the country's reserve base. So they brought those assets back. Now in 2004, I think, yes, 2004, then we had the first marginal field bid round. It was named marginal fields because for the people that bidded for it and won at that period, it was quite substantial for them. And at the same time, for the IOCs that had the bigger Agbamis and the Bongas and the like, it was a bit too small for them. Apologies about it for the whole noise. So it was a bit too small for them. So Now the whole marginal field concept came in. So I've talked about the joint ventures, I've talked about the production sharing contracts, I've got into the marginal fields. Each of these assets have the applicable fiscal terms based on the way it is structured. Okay, so marginal fields, we had the 2004 round. Then in 2020, another marginal field bid round was carried out.
Hello? Hello?
Someone saying something? Can I carry on?
Yes, sir, you can carry on. I'll take care of that.
All right. So in 2021, another marginal field, 2020, sorry, another bid round was carried out. Still churning out about 44 marginal fields that came from that bid round process. In 2021, prior to that, the PIB had been circulating without a final landing. But in 2021, the bill was passed and it became an act, the Petroleum Industry Act. Now, the Petroleum Industry Act is revamping the fiscal scenario in Nigerian oil and gas industry. It's looking to enable people, enable the what's it called, the economy. Looking to enable the economy and build some certain level of foreign direct investments, make the whole oil and gas scenario more attractive for foreign investments and for local investments also. So I could talk more on the fiscal term. I just wanted to give a brief summary or brief rundown of the history of the fiscal terms in Nigeria and the kind of dynamics that played behind all of them, and hence there are different applications when modeling. That's a side story for some other time, or we could talk about that at the end of the session. Okay, so we have revenue streams. The revenue streams will come from sales of upstream oil and gas, cost structures, capex versus opex. Sales from upstream oil and gas is pretty much straightforward. You develop your asset, to produce your oil and gas, and then you sell it off. That's your first line of revenue stream. Now, when we say cost structures, if I put the processing facility in place and I'm able to, and I have excess capacity for processing, nearby assets can decide to flow their own crude to my own processing facility, and I will process for them. I process for them, they pay me for processing and storage. If I have to evacuate for them, they also pay me for evacuation. So that's a source of revenue, a revenue stream from cost structure. So capex plus opex is majorly just building on cost structures, because I just talked about the facility in place. If you're sending to me, you're sending to me for processing, send it to me for storage. Okay, so the first step in modeling is that you want to gather data. What are our data sources? We have historical projected production data, we have market reports, pricing trends. There are green fields and then there are brown fields. From your brown field will be an asset that has produced, a green field, an asset that has not been produced. If you have an asset that has been produced and you're able to get historical data from it, it gives you an inkling of what production will be like. If it's a green field, that's where reservoir engineers will come in and project economics will come in, and we'll talk about production forecasting. Production forecasting will use simple techniques like taking information from analog fields If you have some of test data, we'll talk about material balancing, where we'll have reservoir pressure, we have your PVT and the likes. Market reports. The McKinsey reports, the global oil and gas price forecasting trends, and all of that together will make up your market reports. So these market reports will give you an idea of what global pricing trends look like. Key metrics to collect: production rates. Now your rates are very, very important. If your rates dwindle too fast, it means you're not managing the reservoir properly. If you're not managing your reservoirs properly, then you tend to produce water quickly or water out quickly. So it's why NUPRC, former DPR, would always request that an MER is done, a maximum efficiency rate. Historical prices, like I talked about earlier, would also give you an idea of the trend of all prices in the market. So you use historical prices to make your forecast going into the future for prices. Capital costs. For every single thing we want to put on the asset, we're talking about wells, the subsurface facilities, we're talking about the wells, we're talking about if the asset is producing heavy oil, we're talking about gas lift mandrels, we're talking about injection wells, all of those. Surface facilities on top of a well, you want to have your Christmas tree, you want to have your manifold, you want to have your processing facility, you want to have your flow lines, your pipelines, all of those will comprise of your surface facilities. And putting all of that together will form your capital cost. Cost of operation. Operation costs, okay, let me just brief over it. I think I have it somewhere else in this slide, going into details about operational slides. Operational costs, sorry. For your operational costs, you have brought your oil to the surface already. This oil needs to get from the well to the facility, to storage, and to point of evacuation. The cost of running all of that will be termed operational costs, up down to the manpower, to your insurance, to costs of security. All of those together will form your operational costs. Step 2, you want to define your model structure. So a basic template will be your assumptions. So before I go further, this modeling that I'm talking about now, we're using Excel to model. So in your Excel, if you have your laptop with you, you could go ahead with it. If you are just listening and you have a basic understanding of Excel, you can follow my line of thought, and then we'll move on from there. So in Excel workbook, I'd like to have an assumption sheet, a scenario sheet, an input sheet, a calculation sheet, cash waterfall sheet, and then a project valuation and profitability sheet. Finally, your sensitivity analysis sheet. So your assumption sheet will take into cognizance the kind of fiscal terms you have, the kind of asset it is, or kind of model you're building, oil or gas model, the prices, and all of that together. The scenario sheet will now take into cognizance how many scenarios do I have for this particular project now. I want to build a model and say oil price should be 50, 60, 70. Let me see how viable the project will turn out to be at $50, at $60, at $70 per barrel. So that is the price scenario in that case. You could also have your production scenario. We have a production profile, production forecast. From the forecast or profile, we want to know, okay, if I reduce it by 20%, will the project still be viable? If I increase it by 20%. So these are scenarios you're playing around with. That's for your scenario sheet. Now, in your input sheet, that will now be scenario selection sheet. That sheet will be selecting a scenario from your scenario sheet. To select from your assumption sheet, and then to make inherent computations like royalty, levies, and taxes. Royalty, levies, and taxes. If anybody remembers, towards the end, I can talk about royalty, the levies, and the taxes separately. What's the different dynamic from this? Okay. So from your input sheet, it flows into your calculation sheet. So that's implementation of the previous bullet points. Then you come to your cash waterfall. Your cash waterfall is basically your cash waterfall is basically your cash waterfall, sorry, is it's basically how your line of deductions will go on. You sell your oil and gas produce. Your next line of deduction will be your royalty. You're paying royalty. After you pay royalty, the conversation of the changes. It's now based on there will be a sample model I'll display towards the end with relevance to the current oil and gas industry. So you'd see all of these things I'm talking about. Okay, so from your cash waterfall, you begin to talk about project valuation and profitability. Now, the basic valuation indices that are used in the oil and gas industry, the NPVs, the IRR, the EMV, the EMVs, the UTCs, the UOCs, these are basic profitability indices that are used in the industry. Now, for your sensitivity analysis, so your sensitivity analysis sheet will now be what we hold up from your scenario sheets as discussed earlier. So it's just going to give like a brief executive summary for someone that doesn't really understand the whole modeling process, but then wants to see what's the final outlook or the final results from all the work that's been done in the previous sheets cumulates to. Okay. So for the input assumptions we talked about, the key assumptions to include are oil price, production decline rates, operating expenses, and capital expenses. I didn't include capital here, apologies. So this is a typical sheet that shows your input parameters. You can see for XYZ field, we have production scenario, the low case, the mid case, the high case. This is barrel of oil per day, barrel of oil per annum. We have the fixed OPEX, we have variable OPEX, general admin. I just took a snapshot out so you'd see or have an idea of what it is I'm talking about the scenario and input parameters. Okay, revenue production projections. Calculating revenue. We all know that revenue is production volume times price per unit. Creating revenue streams, we differentiate between various products, oil and gas. So the difference differentiate between various products, oil and gas. Okay, so different revenue streams will come from both oil and gas. There's also condensate. So it will also determine the facility you put in place, how you strip. Sorry, please, I'm a bit distracted. Give me a minute. Okay, I'm back. Revenue streams. Revenue comes from oil, revenue comes from gas. You sell off your oil, you sell off your gas, and you get revenue from there. Some assets do have condensate. Condensate light oil. We're moving on to cost estimation breakdown of costs. Like discussed earlier, we have capital costs, we have operational costs. Your capital cost
Mr.
somebody
Abbas,
talking. Can you mute the mic, please? Cost estimation, breakdown of costs. Like discussed earlier, we have capital costs and we have operational costs.
Adúródé yẹn ẹ ti pẹ́.
Sorry for the inconvenience, so you can go ahead.
Right. Please unmute yourself.
Hello, Mr. Ephraim. If you are speaking to us, you are
Mr. Ephraim
muted
should unmute himself.
and we can't hear you.
Can you hear me?
Oh, yes, sir. Welcome back.
Yes,
We
go
can hear
ahead.
you. Go ahead.
You can go ahead. You can hear you.
All right. So I was talking about wells. Line of thought. Okay, yes, wells. So I was saying even in the capital cost, your well costing will still be dependent on the kind of well you're putting in place. We have the vertical wells, the deviated wells, the horizontal wells. Generally, the horizontal wells will cost a bit more to drill onshore. Offshore wells are a lot more expensive than drilling onshore. Swamp wells are fairly more consistent with onshore well costing. Your production facility will also be dependent on the capacity, the processing capacity of the facility. It's also dependent on the kind of lines that will be installed. Some processing facilities just have the low pressure lines and then the high pressure lines. Some facilities are two-phase separation facilities, some facilities are three-phase separation facilities, with all of that together. So if you put in all of these variables, you'd see the capital costing will vary from time to time, depending on development strategy for the asset. Now, operational cost. For operational costs, we talk about storage, evacuation, processing, G&A, salary payments, security. All of these line payments will all fall under operations because they're not one-time payments. They're recurring expenditure that keep happening. So if all of these together will build up to the financial statements. Financial statements, I like to gloss over this generally because it's not something that we follow in the oil and gas industry. It's a finance banking thing, but I just thought to put it in here. So you have your income statement, which talks about your revenue streams, where money is coming from your sale of the oil and gas, from payments received from other parties for processing, payments received for storage, payments received for piping. All of those come together as your income statement. Then you have the cash flow statement. Your cash flow statement to show your inflow outflow, and finally your balance sheet to show um, what it is. Would show the deficits, the brought forward and the carried forwards and the likes like that. So we get to sensitivity and scenario analysis sheet. Importance of sensitivity analysis. So I'll use this image here to talk about it generally. So I did something simple here for a sensitivity analysis. The assumption here now is that your discount factor at NPV12 with oil price, say 65, for example, after running your inflows and outflows, will the profitability of the assets, the value of the assets will come to 10.28 million. But then for capex is the purple line that has 90.4 million. So basically what I'm saying now is that if I reduce my capital expenditure by 20%, I'll end up with 90 million. If I increase it, it goes negative. So you can see how sensitive the asset is to the capital expenditure in this case. It means your capital expenditure load is a bit heavy on the asset. So simply looking at this, you'd say we should go back to the drawing board and try to readjust our capital expenditure and see if we can find a better way of producing the assets and optimizing costs. On the other hand, we would see the oil price. Oil price is also a bit sensitive in this case. I increase oil price by 20% to that's 120% of input variable increase. I increase oil price, it jumps from 10 million to 128 million. I reduce it by 20%, it goes all the way negative to minus 170 million. Sorry.
Sorry, sir. Hope you're okay.
Yes, I'm fine. Need to take some water.
All right.
Okay, so in the model I'll be showing at the end, would see all of these things and it will be a lot more clearer. So next, we want to review and validate. It's one thing to build a model, it's one thing to audit a model, it's one thing to check for errors in your model. So understanding the kind of asset you're working on is imperative. Key things to look out for when reviewing your model are unified assumptions. You don't want to begin talking about oil price at $60 and in the first 4 years, then randomly $80 will come in for 2 years and go back to 60 again, which is not the assumption in this case because there isn't a straight line price for that period as a base case. So if you do that, it means the results or the output of your model is going to be wrong. It's not going to be representative of what it actually is. Consistency is also key. If you begin with a particular date, for example, you should maintain that date all the way. Because once that date changes, it gives a wrong perception. If somebody picks a date in one sheet and works with that sheet, that page, works with that date in the sheet mentally, then meanwhile in your profitability sheet now, what you're talking about, there's a different date. The NPV calculation will be wrong. Now, validation of input parameters is also key. You need to be consistent and up to date with realities in the industry. If the costing of a well is currently $17 million, for example, tomorrow, maybe because of some oil price crash or something, oil price well costing changes, and you're still working with $17 million. It means you're overloading the project at a lower price, and it will also not be representative of what it actually is. So you'll be giving wrong decision um, guidance to management whenever it is you're making that kind of presentation to them. Equal application of sensitivity parameters. Like in the previous slide where you see 80% less, 120% more. That variance should be equal all the way so that it gives a clearer picture. We're able to compare a stone to a stone, not a stone to a loaf of bread. Now, importance of reviewing calculation and ensuring accuracy. Peer review is pretty important. After building your model, it is also nice to have somebody, a second eye to look at it. It's one thing for you to write something or prepare a model. After going over it over and over, you can keep glossing over one particular error that in your mind is actually the correct thing that should be there, but then you have written the wrong thing. So a second eye, second, third eye, peer review, taking a look at your model will also help confirm the accuracy of what it is you've built. Tools and resources. Major tools used for oil and gas modeling or modeling generally is Excel. Everybody likes to use Excel because it's easier to follow through, it's easier to audit. We have specialized modeling softwares like Palisade and Atos. These softwares are built to cater to some particular needs. Now, if you had Palisade from 2021, 2022, from 2020, 2021, sorry, your Palisade software there will need updating now or will need to be rebuilt by Palisade to include the PIA terms. Now, if they don't have a proper understanding, then it means your Palisade will also be flawed. That's why people like to use Excel. There are lots of learning resources for financial modeling. We talk about online courses, we talk about books, we talk about webinars like this, and we have forums for continuous discussions, even amongst yourselves. So what are the common pitfalls in modeling? You want to avoid overcomplicating the model. It's a very nice thing if you know how to use Excel, if you're conversant with the formulas and functions in Excel. But then when you start writing some heavy codes that are not necessary up and down the whole place, it makes auditing a bit difficult. It's okay, modeling ethics, it's better for you to split complicated processes into smaller chunks. So if I see this chunk, I can compare the next chunk and add to the third chunk. And I know all of that together makes what it is you want to do easy to follow. As opposed to using one big formula to write. As a beginner. So let's avoid overcomplicating our models. Now, ignoring updates. I talked about updates for Palisade and the likes on that end. At the same time, ignoring updates for your own model. You might have built your model based on some assumptions, and those assumptions will change. If you ignore those assumptions, whatever results you build and churn out from that model will be wrong. Lack of documentation. Documentation in this case, when you build a model, it's always advisable to have some note on the side. Concept behind or the concept behind what it is you intend to achieve can be jotted down. So you can make reference to that note. Could be in the notes, literally pen and paper, or it could be on Word or notes in your laptop or wherever. So tips for success, once again, keep it simple, update regularly, and document your assumptions. Now let's come to our case study, Project XYZ. I'll stop sharing for a bit and try to get it open. Okay. Can't I see the Excel? Can you see my screen?
Yes, you can
Yes,
see your
sir.
screen. Yes.
Yes.
Okay, so for this model, this template I have here, I have my cover sheet just talking about XYZ field valuation, table of content. I have a summary sheet where I make my selections from my NPVs to my all price scenario sensitivities. I have my scenario sheet. In my scenario sheet here, like I talked about, I have the price deck, all price inflation scenarios. I didn't include anything for this presentation. We have the Brent price scenarios, $90, 80, 70, 60, 50, 40, and likes. Premium to Brent was not applied but included here. So you can see the way this was built. So this model assumes it begins from the year, from May 2025. All price, this is our royalty computation done here. I talked about royalty earlier. So this is for the PIA. Some people might be attending using their phones. Let me attempt zooming in a bit. No need to go all the way to the end. Major things I need to discuss coming. Okay, good. So based on the PIA, your royalty computation is split in two parts as opposed to what it was in HUD. There's royalty based on oil price and there's royalty based on production rates. Yep. Royalty based on oil price is an interpolated calculation. Okay, let me start from the top. Royalty based on production. So for royalty based on production, depending on the location of your asset and what the asset is doing, different royalty rates are applied. For onshore assets doing greater than onshore assets, marginal field, shallow water, those three assets doing less than 10,000 barrels per day. Doing less than 10,000 barrels per day would have a royalty rate of 5% for 0 to 5,000, 5,000 to 10,000, 7.5%, 10,000 to 15,000, 12.5%. And above, sorry, 12.5%. I didn't write that properly. The way it's structured is that for the first 5,000 barrels, let me change this so it's something you can see real quick. One five, let's go 7,800 here. Okay. So you can see for the first total production rate is 7,800 barrels. For the first 5,000 barrels, you pay 5% as royalty. For the next 2,800 balance of 7,800 of your production rate, you pay 7.5% on that as royalty. That's how royalty on production rate works. for assets doing less than 10,000 barrels on onshore shallow water at less than 200 meters depth and swamp areas. Now, doing above 10,000 barrels, you just go 12.5% on your assets. Now we have shallow water doing more than 10,000, 12.5%, deep offshore greater than 200 meters water depth and doing more than 50,000 barrels per day, 7.5%. These things are something you can research online and see. So that's how royalty on production rate works. Royalty on production works. Next, we're talking royalty on oil price. So royalty on oil price is now dependent. Initially, there was nothing like royalty on oil price, but then given the incentive that PIA is trying to pass out, we're saying in case oil price should drop below $50 per barrel, then we'll pay zero, there'll be no royalty on oil price. But if oil price is above $50, it means that business is profitable and Nigerian government should be able to see something small from it. So between $50 and $100, it will range between 0 and 5%. So there's an interpolation, some calculation that is done to get to that number. Between $100 and $150, it will range from 5 to 10%. Anything above $150 will also be 10% of the oil price used as your royalty on price computation rate. Now we have production forecast scenario built in here. We have a scenario for low case, mid case, high case for production, losses from crude theft. We have operations cost. Operations costs can be split in fixed and variable. For the sake of, let me not go into too much details. Fixed OPEX, variable OPEX. What are your fixed OPEX? Your fixed operating costs are costs that do not recur very frequently. Your variable costs are costs that keep, like salaries, G&A, all of these things that you pay salary every month. When it's time to change some faulty parts or when it's time to pay for some service to be rendered in the process of operating the assets, this cost might change, so that we call them variable. Now we have fixed costs. Fixed operating costs, like if I have to maintain this line or pig the pipeline, that's to declog it from greased oil or kicked in oil in pipeline. Those kind of processes, there's a standard amount I always pay. So I'll just call that a fixed operating cost. I'm trying to simplify the concepts at times, so yeah, it's easy for you to separate in your head as opposed to going into a lot of details. Then we have our capital expenditure. For the sake of the model, I split it into exploration wells, development wells, and facilities. Because when we come to tax computation, exploration and development wells are handled differently. And development wells and facilities are handled as per similar. We know what exploration wells are. Exploration wells okay, so in the PIA also, talking about tax, initially tax regime for oil and gas was 85%. That was petroleum profit tax. But in the current PIA, it's now turned out to be split in two parts. Now we have the national hydrocarbon tax and also in the newly introduced company income tax. CIT used to be just applicable on oil initially, but it's applicable on both oil and gas today. So this is a scenario sheet. Now, if I come to the sensitivity sheet now, you'd see you remember the image I showed earlier that showed 80%, 120%. If I increase oil price by 80%, if I reduce oil price by 80%, how will it affect the final outcome of the model? If I increase it by 120%, how will it affect? So this is where the whole sensitivity comes in. I have my sensitivity done on oil price, 80%, 120%. On production also, I have it also done on OPEX for both fixed and variable, and G&A. I have it done for capital expenditure also. So it's just a simple computation. 80% of this figure will give me this. 120% of it will give me this. Now my input sheet becomes my concept selection sheet. In the concept selection sheet now, it's where I now decide, okay, from this summary sheet, if you take a look at this row, so my concept selection here is $60. So if I just come to my summary, which is 60 here, and change it to 70, it changes in the model. So your input sheet is basically your concept selection sheet. Same applies for production, royalty, and the likes if I go to the summary sheet to select these concepts. So this is what will flow in to my model going forward. All this scenario and sensitivity is just for me to prepare the framework of what it is I want to select in my input sheet working going forward. I mean, the structure of a model does not have to exactly be like this. This is just a general guide. You can decide to build it differently. You may decide to have a different structure for it. There's no one particular structure. Timing and flags. Okay, let me jump this. And you. Okay, I'll skip the timing, financial, and capital allowance sheets because I'll start talking of different concepts again that will apply just to build this. But then basically your input sheet flows into your calculation sheet. Oh dear. Okay, so straight line computations. What's our annual production in this case now? 2.8 million barrels of oil. All times revenue. All times price, sorry, will give you a gross revenue. We have a royalty computation that was done earlier. Remember we said royalty is based on oil price and production. So if we're taking 5% of the production, 5% of 2,847 here times oil price plus the 1% that was there for royalty on oil price times 2,847 will add them together will give you how much it is you'll be taking out for royalty payments to government. Oh, there. This is wrong. It's not